I'm a global macro investor, and economics, markets, politics, and geopolitics all matter. And there were three things that are happening in our lifetimes that never happened in my lifetime or our lifetimes, and that I learned before I had to study past periods. And those three things are the creation of a lot of debt and money. The second is the amount of internal conflict that we're having over money and values and what that's like. And the third is the changing world order with countries like China and Russia competing with the United States in a way that didn't exist before. It's a basic thing. Everybody agrees we need more money and we need more spending. But if you spend more than you earn, you have to borrow. And that creates debt. At first, it's credit, so it gives you buying power. But you have to pay it back, and that becomes depressing. And so in order to avoid that, central banks can print money and buy it back. But when they do that, that depreciates the value of money. So what we had was a lot of money and credit go out to a lot of people, a lot of buying power. Everybody, when they got it, they thought, oh, that's great. And somehow they seem surprised that when they spend it, the prices of everything go up. But the truth is that if you divide the amount of money and credit that's used for spending by the quantity of goods produced, you can calculate, well, the prices will change. And so that's what's going on. And that's what went on in a giant wave, the Federal Reserve and the government together. And that produced a giant amount of inflation, between 7.5% if you use year over year, or if you take the core inflation rate, it's closer to 12 and it's rising. There's some temporary influence, but it's basically because of the amount of spending. You can measure the amount of spending, not because of the bottlenecks. Buying power is what matters, right? So what happens is when inflation goes up faster than your other sources of income, you lose buying power. But somehow that seems more acceptable sometimes to people than if it was just taken out of your pocket. You see, if they, let's say, raise taxes or take it out of somebody's pocket, everybody complains, whoever's had the pocket taken out of. But if it comes through printing of money and everybody gets checks, it's more acceptable. But those who are holding money, like money market funds and bond funds, lose the buying power of that. So think about those bond funds. Those bond funds are like down about 10%, and inflation is up over, let's call it 8%. So they lost 18% of the buying power. We think of it as meaning higher prices, but to some extent, that's a rich man's perspective because they say, oh, now I have to pay more. But the reality is you don't get more stuff from that higher inflation. And so it bids it out of the hands of some people. And that hurts the people who don't get it. And so we're seeing a time now where you're going to lose buying power to inflation. And now you're going to see the Federal Reserve also tighten money and credit and raise interest rates. And when they do that, that creates less buying power. You know, they say, okay, now you can't spend as much money and the prices are going high, but they do that in their crude way of trying to reduce inflation. But you get it from both ends, the higher prices and then the higher interest rates you have to pay and the higher debt service costs and also less availability of money. So it's a squeeze, like the squeeze that happened in the 1970s. These things go in paradigm shifts that quite often take, relatively long time because everybody's mindset is in a certain place and they're doing certain things. For example, investors think that cash is safe and they don't pay much attention to inflation. And then what happens is they get inflation and they realize that if I'm holding cash, I'm losing buying power. So then they shift, they sell out their cash or they sell out their bonds and they put that into other things. And when they do that, that also contributes to inflation. Changes like that also happen in a lot of ways, like cost of living increases in compensation, where in the past, when they don't worry about inflation, then they don't think about, do I have an inflation-linked contract for my work? Or do I have enough inflation assets? It might be, do I need to buy, I'm going to store my money in a house. And so that pendulum swing from one mindset and one positioning to another mindset and another positioning in the early stages tends to be self-reinforcing. Those actions produce more inflation and more inflation psychology until that goes to the opposite extreme.
The U.S. debt crisis could ignite a long-term rally in gold. Since March 2020, the U.S. added another $8 trillion in debt, and gold is up 50%. Buying gold and silver is a defensive strategy when you don't trust elected officials in Washington, D.C. having your best interest at heart. National Gold Group is America's #1 precious metals company. National Gold Group has the IRA Fee Waiver Program. That means they will pay the fees on your IRA for up to 10 years on qualifying rollovers. Call 888-599-2883 to learn about their retirement account fee waiver program. Mention Free Investing and you'll always get best-in-class service from America's conservative precious metals leader. You can also go to their website, buyfigold.com, using the link in this video description.
Like in the 1970s, people were surprised about what happened because they weren't used to inflation much. Then you had the inflation, and in the beginning, it swung. And then at the end of it, they said inflation will never end, and everybody's positioned for it never ending. And then, of course, what happens is it's so bad that then the central bank goes the opposite extreme, and then they get surprised. And so the 80s was a period which was the exact opposite of the 70s, where you have falling inflation, high real interest rates, and so on. And so the worst assets to own in the 70s were bonds, and the best assets to own in the 80s were bonds. So you see these pendulum swings that way. The amount of political polarity is the greatest since 1900. Compromise is the lowest it's been. It's measured by how voting across party lines. There are two monoliths, and they're at war with each other. And we have populism, which is you have to get on one side or the other. So when the causes that people are behind are more important to them than the system is in jeopardy. The risk of neither party accepting losing the elections is significant. The move toward power dynamics. The idea of democracy is compromise, reaching across that the law and the rule is of a higher purpose than anything else. But when you get other things that are more important to people, that they're willing to fight for, then you get greater and greater. And it's self-reinforcing because moderates are people who want to work across party lines and so on, and compromise are through history, through the French Revolution, Russian Revolution, Chinese Revolution, or these are civil wars. In all of those cases, the moderates, they're hurt or they're disposed of, and you have to pick a side. But you're seeing this now. The ideologies are dominant. So for example, when Elon Musk buys Twitter, the decisions he will make regarding Twitter will probably have a greater effect on our society than the decisions the Supreme Court makes. It's one of the symptoms that it's not normal economics in the usual way. So it's a different game that people should be aware of. I have a principle, which is that if you worry, you don't have to worry. And if you don't worry, you need to worry. Because if you worry about things like if you read about the consequences of what has happened in history, and you look at the likelihood and you say, okay, we can have this kind of a conflict, or we could have that kind of a conflict, external conflict, and boy, these conflicts are terrible. Maybe that sort of brings us more together because we have the power together if we don't fight each other in that way, and we can compromise and so on. I was just in Singapore, and what they had is they had savings. Because they have a large savings, the income from that savings covers 20% of their budget. So one generation is giving the other generation a savings, a good education, and civility. And this happens in certain places. What we have left our generation with is debts, a broken down infrastructure, and fighting. I mean, the answer is if we're all good with each other and we're productive and we earn more than we spend, we won't have a problem. But we got to get there. If I was president of the United States, I would have a bipartisan cabinet to try to bring moderates from both sides. I'd have an economic program that was put together like a Manhattan Project in which smart people from both sides would make changes. I have my own changes that could happen in which they would both increase the size of the pie and divide it well. I mean, move much more toward equal opportunity in which people are productive. I'll describe the cycle. By an order, I mean like a world order or domestic order, the system that's in place run by the people who have the power, and then they determine what the system is like. So you change orders, usually by wars, because you have a conflict. And then, okay, how do you resolve the conflict? They have a war. So World War II ended in 1945. The United States won World War II dominantly. It became the richest country in the world, having 80% of the world's money. Money was gold then. It had 80% of the world's gold. And a dominant military. It had a monopoly on that, and it accounted for half the world's economy. And so it set the rules. It's the reason why the United Nations is in New York and the IMF and the World Bank in Washington, D.C. It was the American world order because it was dominant power. Now, when you are in a dominant power, also these wars are sort of great equalizers. People come back from the war. It's not like some are rich and some are poor in the same way. There's a restructuring and you don't have the same wealth gaps and resentments and so on. And that usually means that you have a period of peace and prosperity. Peace because nobody wants to fight the dominant power. And then they work together and they produce peace and prosperity, and that happens. And that's really does best in the capitalist system, in which capital is provided to those who have good ideas because they say, we'll invest in you and you'll be productive and so on. But what capitalism does at the same time is it creates large wealth gaps, and it also creates higher levels of indebtedness. So it creates the large wealth gaps because it distributes that unequally. And then that can be self-perpetuating because those who get power, like if you have more money, you can educate your children better. Gradually, you lose equal opportunity and you produce wealth gap and you produce resentments. And you also then create larger amounts of debt quite often. That means that that's a problem down the road. Now, what happens when you become the world's largest power, this is also always the case. It happened with the Dutch, it happened with the British, that because you're so powerful on production, you go all around the world and you are the largest trading country in the world. You get more exports than other countries and more transactions are in your currency. And so everybody uses your currency, which becomes the world's reserve currency. And because it's the world's currency, different countries save in it, which means that they lend to you in it. And that increases your debt to foreigners because when they hold a bond or they hold cash in that, they're lending it to you to get the dollars back in the future. And so that is also one of the ingredients of making a top. There are the wealth gaps, there's that. And then there's also a change in generations and generation psychology. The greatest generation, in a sense, are those who fought through the war, appreciate basic things, that kind of a thing. And then what happens is when you're on top, you become more expensive and quite often more decadent. I mean, you might spend on things that are not good investments and don't last very long or whatever, for entertainment at the sake of buying. So for example, in the United States, I remember when we had a per capita income, which was 40 times China's, and we started borrowing from China. So these are the ingredients. And then you start to see that they cause problems, the financial problem, the internal conflict problem, and so on. And then the type of fighting that we're talking about. It's so interesting because in the mid 1600s, this is interesting. There was 30 years of war. They call it the 30 Years' War in Europe. And they just kept beating the daylights out of each other. And that is when they invented countries as we know it. Before then, there were no boundaries. And what mattered was power. And if you wanted something that the other guy had, you'd go get it and he'd do the same with you. And there was this constant fighting about things. And then in the 1600s, they were fighting about religion too. There's the religious Reformation and the others, which also had to do with power because the church was powerful. But anyway, so they invented countries as we know it with boundaries, and you determine what goes on in your borders and so on. And of course, for the next 100 years, there were hardly any wars. But when the time comes, there's no universal legal system. There's no universal policeman. So if you don't have a universal legal system, there have been attempts at that with the United Nations or before that, the League of Nations. They attempted that, but power rules. And so you're going to have tests of power. It'll come down to tests of power. I want everything that I do to not be opinionated. A very big leading indicator is the relative level of education. And those that have more educated population, and you can see the numbers rise, you could see education levels in one country or another rise or decline in these charts. So you could see how is the United States in its education and how are other countries, and is that gap improving or worsening? Because education levels are very indicative of well-being and economic behavior. Rule of law, countries that have rule of law and respect for the law that keeps order and effectively, when crime rates go up, it's a problem. A very good indicator is corruption levels. There's a corruption index that all countries have. You can see how it changes. And as it goes up, there's a negative 52% correlation with the growth of a country and its corruption over the next 10 years. The USA is reasonably good on the corruption element. Russia is bad. It's interesting because these are predictors of the future. And what you find out is, like, if you look at Russia, I'll give that as an example. It's blessed with the greatest natural resources of any country in the world. The value of its natural resources are 40% higher than the next highest country, which is the United States. And it does a pretty good job of having an educated population. It's not heavily indebted and so on, but it's cultural issues in terms of these things like corruption. Also, there are measures of bureaucracy versus efficiency. Lots of measures of attitude. Can I start a business and make my dreams happen? You can see the differences between countries on just that attitude, okay? And also you could see it in the bureaucracy. How long does it take to set up a business? There are statistics like that. If there was education and experience from the age of 5 to 15, that would change everything. We learn differently. Scientists have shown prior to puberty, we learn in an internal way. And you'll find that a number of people had their passion at around age 12, because that has to do with how the brain changes. But if you take that 5 to 15 and you incorporate it in the education system and the practice of saving, spending, and so on, you don't need a PhD in this thing. The money thing is kind of very basic, If I can buy it for less than I sell it, that's a good thing. Mm-hmm. The more volume I could do, the better it is. Then there are fixed costs and there are variable costs. So if I'm going to build a lemonade stand, okay, what's that going to cost me? Okay, That's a capital expenditure. Sure. It's all the same stuff that you could learn, at those ages, and you don't. I spent a lot of time in China starting in 1984, not to earn money because they didn't have any money, but because I was very curious. And then I got to know and like the people, and I was able to help them develop their stock markets and things. And so I watched. Since 1984, when I first started, per capita income has increased by 26 times. The poverty rate, measured by hunger, went from 88% to less than 1%. And life expectancy increased an average of 10 years. Hunger was 88%, that type of poverty. And so what has happened is they have become a roughly comparable power of the United States, in some ways a bit ahead, in some ways a bit behind, and so on. And that's in most things. If you talk about military, is it in that region? Is it of that type? Or is it another type or something? But it's comparable. If you talk about technology, when I first went to China, I would give $10 calculators to people and they thought they were miracle devices. Now, if you take it in artificial intelligence and most technologies, there depends on the one. There may be ahead in some and not. So what that means is that they've come up to be a leading competitive power. There's no other competitive power like that. Now, a lot of countries now, which is scary, are roughly comparable in military, meaning if you have a war, if we have a war with Russia, it's not like the United States is militarily dominant or so. And there, more countries have become that way. We spend more and we have bases in 70 countries, but at the same time, that means we're overextended or extended. And it doesn't mean that you'd win a war. If there was a war in Europe, everybody'd be a loser. And there are different types of wars, cyber wars, as well as military wars and the like. What we're now having is a situation where there is that rivalry that could be good, healthy competition. However, history has shown when you deal with who's going to set the rules of the game, there might be disagreements. And if there are disagreements, how are they resolved? Like the trade dispute. It's not like both sides took it to the World Trade Organization and say, we're going to plead our cases, and then you make a decision. They didn't even think about that, right? They go to, I'm going to do this if you do this. And that's where we are, sort of. So the world is breaking up into these parts where there are two sides, kind of. Like if you look at World War II, by way of example, there are the Allied powers and the Axis powers. And then they're in Europe and in Asia. And there are different alliances in Europe than there are in Asia, because each has their own interests. And it's developing that way. So when you take the Ukraine and you look at the Ukraine and that's more aligned with the other side, let's call it the Axis powers, which are the challengers to the United States and to some extent the NATO powers. And you have that conflict. And you could see in a number of statistics or actions how the sides are lining up. Like, for example, they just ask, are you going to apply the sanctions or not? Are you going to do this and that? In the United Nations, did you vote against Russia or not? And so on. And you could see all those things and you could see how the sides line up. For example, India lined up with Russia. So you could see how this is lining up. And you could see that we're coming into this. There's no conversations and communications that's even polite between the two countries right now on these things. And that's where we are. And if you look at history, that's a dangerous place to be. I think that there's better than an even chance of a bad stagflation, a very bad stagflation, because of the dynamics. I'll say 1 in 3 chance, but I think it's actually probably higher than that we have a type of civil war, internal conflict, in which the rules are not followed, the compromises are not made, that maybe they don't accept losing an election, that there's movement of people to different states that they believe represent them better. And there's a polarity developing and they're going to different states, and that there's not obeying the central government. So now it becomes a power game. I'm in the business, I need to be objective because accuracy is my thing. I have to be as accurate as possible. I'm not saying that's accurate, but I'm saying when I look at that, I don't think, my assuming that's 1 in 3, I think it's actually probably higher than that there will be that kind of a situation. And I think it's higher than a 1 in 3. I think maybe significantly higher, that you get into the same conflict in the power internationally. For example, does Russia or the West win the war in the Ukraine? I'll define Putin winning the war as 3 things. He gains control of the eastern part of the Ukraine. Russia's economy is not devastated by sanctions, and he remains in power. So that's him winning the war, because in the beginning of that, it was worth his cost. I mean, he wants more than that. He wants a neutral Ukraine or an aligned Ukraine, but he's not going to probably go get that. But that's the minimum. Now, that's him winning the war. That's also kind of the West losing the war. But if he loses the war, if he loses that, he will probably escalate, okay? Because the war is now being played as a on the ground, armies to armies, and with sanctions. But he has other weapons. And rather than go down, he will probably escalate. That's a game of chicken. It's a very dangerous game. And there are other issues globally. For example, you're seeing these alliances work out, and the United States, for various reasons, sort of pull out of the Middle East, and you're seeing China more move in. And so these tensions exist and power exists. There are more countries that have nuclear weapons now than there were. You know, there's even talk of joint military operations between China and Iran. And so you see these sides begin to align. So if I say that there's a 1 in 3 chance of some kind of a military confrontation, that scares the hell out of us, or that is extremely, I don't think that sounds too high. I think it's larger than that. So that means I think we're headed for some risky times, because any one of those things is not normal. It's pretty bad. If everybody worries, they don't have to worry. If both sides think about what that's like and say, I can't, we must come together and make sure that that does not happen. The best assets to not own, that's the most important, I think, is cash. I'm quoted, cash is trash. There will be a tightening here for the time being, and that tightening will have an effect. It'll hurt asset prices and so on. But cash is not the asset to own, and bonds are not good to own, in my opinion, because it's debt. It's owning somebody's debt. And you won't get a return. Think of it, the interest rate will not reach the inflation rate. So that's the problem. Then what you have to have, I think most importantly, is a well-diversified portfolio of other assets. Diversification is a very powerful tool because it can reduce risks without reducing expected returns. Now, there's lots of ways of getting what you think good investments are. They might be things you know about, local businesses and so on, or they might be stocks, or they could be maybe a little gold, or maybe a little bit foreign investing. Diversification is very important to do that in a balanced way. So I would generally say that would be what I would recommend. This was 1982, 83. I had to borrow $4,000 from my dad to help to take care of my family bills. So I remember thinking, how many weeks could I live if I lost my income? And I started counting in weeks. I think that's the way to do it. And then assume that its buying power over the next number of years can fall by 3 or 4% a year. Or if you put it in a risky investment, like stocks or something, It can fall by more. So cut that number maybe in half and have twice as much, because you have to understand that that's your freedom. That is your safety. So that first band, you must take care of that. Once you get past that and you feel, okay, I could take care of my family in a worst case scenario, then you have the freedom to then take other kinds of risks. But when you're building that portfolio, it's the same thing as when you have a lot of portfolio past that, just you want to diversify well, because you could see what happens to the markets. Every market, stock market, bond market, most markets have had times where they've gone down over an extended period, 60 or 70% in buying power. One thing I do for my kids and grandkids, and always did, was for every holiday, like Christmas or their birthday, I would give them a gold coin. And I said, I never want you to sell that gold coin until there's an emergency, a real emergency, never because you want to buy things. And the reason I did that, and they'll build over a period of time. And I said, don't even sell it. You pass it to your kids unless there's an emergency. And so you're building that savings. Because I think we so easily spend so much money on junk. I didn't like debt because of the fact that there's an obligation and it's like, oh, if I get, then I'm going to be drowning. I'm trying to keep my head against water. This is just my own bias. But anyway, the truth is, if you find individual bets that are diversifying, that your return will equal the average of those returns, but your risk can be cut by 80%. By a bet, I mean, like if you say, I'm going to invest in the stock market, you can see whatever the bet is, look back in history, it gives you a pretty good idea of how it goes up and down, what your risks are. Do that by looking at it in inflation adjusted terms is the best way, but it goes up and down and you can see how your buying power is. If the worst case happened, what would that look like? And I'm telling you, like I'm saying, that the worst case is when you look at that is something like 60 or 70% in buying power, whether that's stocks or bonds. However, if you do that with uncorrelated investments, like when commodities go up, bonds go down, that kind of thing, and you balance things, then you find some part goes up when the other part goes down. And by doing that, you can reduce the risk without reducing the return. Holy Grail means if you follow this path, this will be the key to your riches. 10 to 15 good uncorrelated return streams. I always have to think about what's the worst case scenario. Can I handle the worst case scenario, whatever that is? You can be a great investor, or you can be great at anything, and it'll only be one time that knocks you out. One time will kill you. It's often the case that I believe I can produce a significantly higher return, I have, than the cost that I pay for debt. So it's a logical thing to do it, and I still don't do it much. And there's one thing about debt for consumption and debt for investment. Debt for consumption is really bad because the asset goes away and you're left with this obligation. And, that's risky and it's stressful, piles up. You're living above your means. Don't do that. It's not a good idea. Whereas if you have debt for investment, you better be pretty sure that the returns on that investment will be higher than you have to give back in money in the form of both interest rates and the principal repayments. The best investments are typically those things that you're closest to, and they fall into two types. Those that affect your living standards. Like I think owning a house or an apartment or your residence affects your life a lot. And the cost of it is not the cost of it. In other words, you buy it at a certain price. It's not like the thing that goes away and you consume. So you'll sell it at a certain price. And probably you'll modify it over a period of time. You'll make things, and it produces kind of a forced savings that also brings you joy and brings you a better environment, generally speaking. So, and then the other thing is things that you might know really, really well. Is it your own little business? But you could still take the cycle. So those are the two things that I think that are good for. I should say that one thing when I did that, I discovered the three forces that I mentioned. I discovered a fourth and a fifth that are very important and big. One is that, interestingly, acts of nature in the form of droughts, floods, and pandemics have had a bigger impact than the things I've been talking about in terms of cost more lives or toppled more civilizations, those acts of nature. So I think that's something probably that we have to be concerned about. But number 5, over long periods of time, 10, 15, 20, 30 years, the most powerful force is man's ability to adapt and invent. Here's a Great Depression and here's a war. And as you see those things, they look like blips on the chart of life expectancy, per capita income, and so on. So there's a tremendous capacity for dealing with all the other stuff if man can adapt to it well. And inventiveness during this period of time should be kind of, I think, really great, because what we're using more and more is types of technology, artificial intelligence and so on. The ability to think and collect data and use the computer to help us with that is a very, very powerful force. Now, like any force, it's also a risky force because it can be used for bad as well as for good. I think the world will evolve. We will have these cycles in the world. So that's what you see. You see these cycles, and then you see evolution through those cycles and adaptation. And so I expect that. But I would say there's the probabilities I gave you before, that concern me. A lot will be unknown. We have a lot of potential and a lot of things to worry about. I think we're in an era of that money as we know it, which is a fiat money, is being devalued, and it's going to change. The dollar's role is going to change, and that alternatives are going to compete with that. So I wouldn't want to own money when you own a dollar, let's say, is in the form of a debt instrument. So you're going to get paid back in that. And I think it'll have a negative real rate, negative buying power, and so on in almost any currency. And they're all competing. So they're all devaluing, essentially. And so money is both a medium of exchange and a storehold of wealth that is portable and works in most countries. And now we'll find out what those things are. Gold is an example of one of those, and crypto is an example of those. Maybe NFTs are, and who knows? I think we're in a kind of a who knows kind of phase. New things come along, and I think they'll compete. People will start to think about, how do I have a portfolio of those things that are widely accepted, that I can and that maintain buying power? There's challenges to that. Like when you have a lot of volatility in it, it means that, oh my God, my owning it is more risky than my not owning it. And so that drives money into sort of other things. But anyway, we're going to struggle with that. And you're going to see digital currencies in different countries and so on. And I honestly don't know. I don't think one thing wins out. I do think that a lot of the crypto, like all markets, they go through phases. And there's kind of the bubble phase where it goes up a lot and everybody believes it and everybody's bought it. And then you have the adjustments and so on. I think there's too much emphasis in it because the total value, of Bitcoin or even the cryptocurrency is comparable to the value of Microsoft. One has to think, when one thinks of assets, I would rather think of the whole array of assets than to think about, just, is it going to be that crypto Bitcoin one?
Yes.
I think people can be too concentrated on that. And I think that can be dangerous. Diversification is my key. Let me start off by saying I acquired it by an accident because the game that I happened to fall in love with, if you learn to play the game well, it pays well. Well, I think that's true with a lot of people who are coming up with ideas and building businesses and so on. They got excited about it. It works well, and then it pays well. To me, it's a serious mistake thinking that success is measured in such things because money has no intrinsic value. Okay, what does money get you and what do you need? Now, what I want is freedom and the ability to be creative and do that's what I want. And money helps me get that. It helps me help other people. It helps me have the impact. I like those things about it. I think that success is having the life that you want to have as long as you're earning more money than you spend. And that can be spending very little and having a wonderfully luxurious life. I watch a lot of people don't have much money of different ages, sometimes young, sometimes older. They travel around the world, they backpack, they go to different cultures and different places. They can live in a tent and the most beautiful nature is available to you, or you can be in a hostel, or you can meet in so many different, and freedom and so on. I think everybody should almost experience that to know that they can have a great deal of freedom without a great deal of money. And that status thing is a silly thing. Okay, that's like being hung up on living your life for approvals. And so don't get on the track and lose sight that, okay, what is it that you really want in your life? What is a successful life for you? It's not measured by how much money you have or how much status you have or almost that other stuff. It's measured in, like I would say, meaningful work and meaningful relationships. If you have something as your work that you're into and your craft and it's the thing you love, and you have meaningful relationships, I think those are the most important things to make a rich life.
National Gold Group is Consumer Affairs top-rated gold IRA dealer. Call 888-599-2883, 2883, 2883. 2883.
I think we're in a very dangerous place. Must be worse than a recession. The middle class is getting wiped out. We've been talking about this for months or longer. And this was at a time when the Fed was saying inflation is coming down, Wall Street's inflation is coming down, they're going to cut interest rates. The Fed was still saying, we expect 3 interest rate cuts between now and the end of the year. I mean, they were saying this in the beginning of April, 3 interest rate cuts between now and the end of the year. Everyone thought that there would be no cut at the May meeting. Nobody thought that. But you still had June, July, September, November, December. That's 5 meetings. The Fed's on a crazy schedule. They don't meet every month. It's like every 6 or 7 weeks, but 8 meetings a year is what it boils down to. So you had 5 meetings, June, July, September, November, and December. And you're talking about 3 rate cuts. Okay, no problem. 5 meetings, 3 rate cuts. That seems to work. Except, and this is what we said a while ago, inflation is not coming down. Now, that's the story. That's the narrative. That's what Wall Street likes to talk about because they just want to sell your stocks. So it goes back a couple of names. The first name is the pivot. When would the Fed pivot from rate hikes to rate cuts? That's the infamous pivot. They stopped hiking rates in July 2023. So that is true. They're just on hold for the time being, but they're not even close to a rate cut. And that's what we've been saying. But Wall Street started talking about this 2 years ago. It was the summer of 2022. Remember, the Fed started raising interest rates in March 2022. At the time, rates were zero. When I say rates, we're talking about the Fed funds target rate. So it's a very, really short-term overnight rate. We're not talking about 5-year notes and 10-year notes. Those are different. But the overnight rate that the Fed targets, it was zero at the beginning of March 2022. Well, they just started hiking in March 2022. They finished in July 2023. So about 15 months of rate hikes, and they got it up to 5.5%, which is where it is now. But Wall Street started talking about the pivot in the fall of 2022. Now, they didn't say it was going to be that month, but they said, early 2023, the Fed's going to cut rates. Well, then that turned into like mid-2023, and then it turned into late 2023, and then it turned into early 2024. Here we are in mid-2024, and they were still talking about it, but they've been wrong for almost 2 years. And we said they were wrong. We didn't say the Fed was going to raise rates. You can't take that off the table, but we said they were definitely not even close to cutting rates. So what's the kind of backstory on inflation? Inflation peaked in June 2022, 9.1%. And by the way, let me just do a quick footnote on the definition of inflation. It shouldn't be complicated, but people make it so. When I talk about inflation, I'm talking about the Consumer Price Index, CPI, comes out monthly, computed by the Bureau of Labor Statistics, and it's measured on a year-over-year basis. So you look at the monthly index and you say, what was it a year ago that month? And then that's it. That's how they compute it. That peaked in June 2022 at 9.1%. By the way, the highest since the early 1980s. You got to go back over 40 years to find inflation that bad, but it was 9.1%. By June 2023, so a year later, it had come down to 3%. The Fed was putting up the mission accomplished banner. Well, it wasn't mission accomplished. Yeah, 9.1% down to 3%. Nice job. But it wasn't 2. I mean, they were trying to get to 2. They had what they call the last mile. How do you get that last little bit down? Well, the problem is it's been going up ever since. So here we are almost 10 months after that low of 3% in June 2023, and it's higher. Inflation is higher than the prior month and, at this point, the prior year. So inflation is not just stuck. It is stuck, but it's actually been going up. All you have to do is look at that. And if you're worried about inflation, if that's your job, you're the Federal Reserve, your job is to get inflation under control. And inflation has stopped coming down and is starting to go up. How on earth are you going to cut interest rates? Well, the answer is you're not. You can't do it. Jay Powell was like, well, we've seen good data and we need a little bit more. He said, we're not quite there yet. We're just about there, but we need some confirmation, I think was the word he used. So a couple months like that, and then boom, we're ready to cut rates. They never got the confirmation. It went up. And why was it going up? Well, oil prices were a big contributor. When oil prices go up, it filters through the whole supply chain. So gas at the pump is an obvious one. By the way, if you go to AAA gas prices, AAA has a really good chart, and of course they get their finger on the pulse. And they show regular gasoline nationwide average. They can break it down 100 ways, but regular gasoline nationwide average, that number is higher than it was last week, last month, and last year. It's been going up, of course, just in time for the election. This is not something that Joe Biden particularly wants to see. But it's not just gas at the pump. That's the most visible sign. People, they know. They pull up at their gas pump and say, price went up again. It's costing more to fill up my SUV or whatever it is. But that price filters into everything you buy because everything involves transportation. If gasoline's going up, diesel's going up. Well, everything moves by truck or train, as the case may be, but mostly trucks. Everything you buy in the store, every loaf of bread, canned goods, fresh vegetables, whatever, it gets there by truck, and the trucks have to pay more for their diesel. They have to charge more for the freight, and then someone's going to have to raise the price of goods. So because of the transportation effect, which I just described, and a lot more, airfares, jet fuel, etc., the price of oil and the price of refined products, gasoline, kerosene, which is jet fuel, and diesel go up, and then everything goes up. So that's one of the drivers. It's not the only one, but it's one of them. And how's that going to change in the short run? 2 of the 3 biggest oil suppliers in the world are Russia and Saudi Arabia. U.S. is the other one. Well, Russians and Saudi Arabia, and by extension, OPEC, they're called OPEC Plus, are cutting down on production. Now, they're fighting a tide. I mean, the world kind of wants to deflate or disinflate. And that is happening around a lot of the rest of the world. It's not happening in the United States. There are other reasons for that, including, concerns about the geopolitics. Iran just hijacked the cargo vessel in the Straits of Hormuz. The Houthis have shut down the Suez Canal. The big oil tankers are going around the Cape of Good Hope in South Africa. It's a long way. The oil's still getting through. I'm not saying that you're not going to be able to get gasoline. I'm just saying that if you add transportation costs and time delays and geopolitical uncertainty and other factors on top of what we've already seen, this is what you get. The economists always say when they dream up these things, it's because they don't have enough to do. So I talked about CPI. Well, they invented CPI core. That's when you take out energy and food, and that's a little more well-behaved. Well, thanks, guys. The energy and food is what most people spend most of their money on. You can take them out and get a different time series if you want, but that's not what people actually pay. They pay CPI. And then they came up with something called Supercore. Well, what's Supercore? Well, Supercore, you take out food, energy, and housing. Okay, so if you live in a tent and eat canned goods, fine, but those are the three biggest things that people spend money on. Gas at the pump, food at the grocery store, and housing costs. And then, of course, the energy price feeds into home heating, air conditioning, whatever you have. This is like 70% of the average household budget, maybe more. And they say, well, we don't count that because we're eggheads. Take everything I just said, and there's another inflation index called PCE, Personal Consumption Expenditure. That's the one the Fed uses. Same thing, PCE, PCE core, PCE supercore. It's all garbage. You can compute it. I understand it. I can look at a spreadsheet or an equation and understand it. But I also understand that that's not what people pay. People pay CPI. That affects their attitude towards the economy. That affects their political outlook. That affects everyday behavior. It affects other consumption. If I'm spending more at the gas pump, okay, I have that much less to, go out to dinner or buy a show ticket or some new clothes or whatever it is. So this has ripple effects that are enormous. Some people, I would say theoretically, you can distinguish between supply side inflation and demand side inflation. The difference really quickly. Supply side is kind of what we've been talking about. Oil shipments are reduced. Bottlenecks go back to 2021, 2022 when the supply chain broke down. And there are concerns about that. Economic sanctions coming out of the Ukraine war, new economic sanctions on Iran. Those are all things that affect the supply side. But a funny thing can happen, which is if it persists long enough, it leaches over or spreads over to the demand side. The demand side is psychological. It's people saying, this inflation, it's hanging around longer than we thought. It's getting worse. I was going to buy a new refrigerator in 6 months. Maybe I better buy it now before the price goes up. And then, a new car or furniture or whatever it might be. I better go get it now before the price goes up. That is a psychological, behavioral factor. But if enough people do it, guess what? You start bidding the price up, the manufacturers can't keep up, etc. I think we're in a very dangerous place. Meaning the inflation right now, what we just talked about, is coming from the supply side. So that's pretty clear. But at what point kind of tip over into the demand side? We're starting to see that. We're starting to see pretty good union contracts are getting pretty good raises. States are raising minimum wages, etc. A lot of that's counterproductive. Certainly the minimum wage tends to lose jobs. But in the short run, if you have to pay people more, you're going to raise your prices. Somebody went into a McDonald's in California the other day and ordered like a normal meal, 12-piece chicken, Big Mac, whatever. And it was like $25. You don't go to McDonald's to spend $25. You must go to a restaurant. That's how the California minimum wage law is starting to filter through into prices. So it may tip over to the demand side. But in the short run, I'll just wrap up by saying the following, Matt. Wall Street's been wrong for 2 years. By the way, the expectation today is that there may be no rate cuts through the end of the year. I think that's probably right. And then, of course, the Wall Street Bureau, they're always out of touch. They're staring at the screens all day. So they say, yeah, okay, you're right. Not June, not July. So they're going to raise in September. Are you kidding me? The September Fed meeting is 5 weeks before the election. Do you think that the Fed wants to walk into the election buzz off? They cut rates in September after not doing it for over 4 years. 2020 was the last time they cut rates. 5 weeks before the election, they cut rates. That's the last thing the Fed wants. The Fed says we're not political. They are highly political. Trust me. I've worked with senior Fed officials and partners with former Fed vice chairs. I spent a lot of time with the Fed as a regulatory lawyer. They're highly political. They read the papers, as the saying goes. So they're not going to cut in September just for political reasons. Then now November, December, if you're just looking at inflation, you're not going to cut. But if we're in a recession, which we may be, that's a separate topic. You may have to cut because of the recession, because of rising unemployment. But the Fed thinks that can't happen, and Wall Street thinks that can't happen. I have news for you. It can happen. It has happened. So what do you call the combination? The Fed's assumption is if unemployment's low, inflation gets high. If unemployment goes up, inflation comes down. That's the Fed's assumption. So they actually don't mind if unemployment goes up a little bit because it'll bring inflation down. But what happens when you have high unemployment and high inflation at the same time? The Fed thinks that can't happen. It has happened. It's called stagflation. Stagnant growth with inflation and prices. I lived through it in the late 1970s, early 1980s. Unemployment was 10%, but interest rates were 15%. Don't tell me unemployment and interest rates move inversely. Sometimes they do, but sometimes they can both go up together. It's called stagflation, and I see early signs of that. So it's a little bit troubling, but all I can say to our viewers is Wall Street always gets this wrong. The Fed always gets it wrong. The reason they get it wrong is because their models don't work. Their models are garbage, but the inflation is real. It's going to stick around, but growth seems to be slowing. So we may end up in this kind of stagflationary episode. So QE, which doesn't work, they printed $10 trillion and the economy was flat to down. For the 10-year period from 2009 to 2019, so coming out of the global financial crisis in 2009 until COVID, average annual growth in GDP was 2.2%. During the Reagan administration, 1983, 1986, the U.S. economy grew 16% in real terms. That was over 5% a year for 3 straight years. That's growth. That's what the American economy can do. Even if that's not totally sustainable, you should be able to grow 3.25%, 3.5% on a consistent basis. That's what a developed economy should be able to do. So 2.2% is pathetic. I mean, you can get up pom-poms if you like, but that's what we have for 10 years. My view is that the U.S. economy has been in a depression since 2007. And people say, well, wait a second, Jim, recession is 2 consecutive quarters of declining GDP. And that is the rule of thumb. It can last 3 quarters, sometimes longer, but they tend to go 6 to 9 months of declining GDP, 2 or 3 quarters. That's the technical definition of a recession, and it is. And so people say, well, depression must be worse than a recession. So if recession is 2 quarters, the depression must be 10 quarters of declining GDP. And we have not had that. But that's not the definition of a depression. A depression doesn't mean continual declines in GDP. It means below trend growth. It means depressed growth. And it was what I was just saying earlier. If growth potential is 3% and you're growing at 2%, that gap between 3% and 2% over time is trillions of dollars of lost growth. Has the economy been growing? Yes. It grew in 2023 and so far in 2024. But it's depressed growth relative to potential, and that's what a depression is. And if you want an example, just look at Japan. Japan has been in a depression since really 1990, December 31st, 1989. They rang that New Year's Eve bell, and then boom, the stock market fell out of bed. It declined, I think, 75%. It just got back. About a month ago, the Nikkei index just got back to where it was in 1989, which is about 40,000. So nice going, guys. It took you 34 years to recover your meltdown. And that's all they've done is recover it. It hasn't gone up much since then. Japan has had 9 recessions since 1990. Well, you can chart the recessions, but I call it one long depression. It's a 34-year depression. I would say the U.S. has been in a depression since 2007, so that's 17 years. We got 17 more years to go. But that's why everyone's out of sorts. That's why real incomes are not going up. That's why income distribution is, the rich get richer, as the saying goes, and they do. And everyday Americans are falling behind, and the middle class is getting wiped out. You can still look for a technical recession within that time series. So QE doesn't work. Government spending and deficits, that's fiscal policy. So QE is monetary policy. That's what the Fed does. And deficit spending is fiscal policy. And that's what the Congress does. How does QE actually work? Well, everyone says the Fed's printing money. The Fed's printing money. Well, what's your definition of money? I mean, the Fed has 4 definitions of money. So start there. They have M0, M1, M2, M3. Some people think Bitcoin is money. You get to a point pretty quickly where no one really knows what money is. So how does QE actually work? How does the Fed print money if that's what they do? Well, the way they do it, they buy bonds from Wall Street. They call up the primary dealers and they say, offer me 10-year notes or offer me 5-year notes. So it's your Goldman Sachs or Citibank, whatever. You quote an offer and the Fed says done. And then the dealer delivers the bonds to the Fed, and the Fed pays for it with money that comes out of thin air. So the Fed gives the money to the dealer to buy the bonds, and that money comes out of thin air. That's M0 based money, printed money. The question is, what does the bank do with the money? The bank just sold the bonds to the Fed. They got paid. What do they do with the money? They give it back to the Fed as a deposit, something called excess reserves. And the Fed pays them interest. Just the same way you get interest on your bank account, the Fed pays interest. It's called interest on excess reserves, IOER. All the Fed is doing is building up the balance sheet. The asset side is being built up with bonds. They're buying bonds. And the liability side is being built up with deposits from the banks, which are liabilities from the Fed's point of view. So you're expanding the balance sheet, but the money's not going anywhere. All the QE money, $10 trillion, never went anywhere. They paid the dealers and the dealers gave it back to the Fed. It was sterilized and never did anything. So was the money printing? Yeah, if you're using M0 to measure, but it didn't do anything for the economy. It doesn't stimulate growth. Ben Bernanke was full of it. Jay Powell's a little more honest. Janet Yellen, she's kind of a affirmative action dunce. They didn't understand any of it, and it definitely did not work. So why is the economy growing? I kind of painted a gloomy picture from the supply side and real incomes and a lot else. But the economy is growing. That shows up in GDP. Why is it growing? The answer is fiscal policy. Deficit spending. That's completely different than monetary policy. That works because, well, it works in the short run. It can be inflationary, but it works because when the government spends money, they're giving it to somebody. The money that the Fed created, they give it to the banks give it back, end of story. The money that the Congress spends, the deficit spending, it's going somewhere. It's buying weapons. It's going to food stamps or welfare or Medicare or Social Security checks or, the Green New scam or, a lot of it's kind of wasted, but it's going out into the economy. People are getting paid. Corporations are getting paid. They're paying their workers. That money actually does create growth, but there's another problem associated with that. So the short answer is monetary policy doesn't work. It's a joke. We follow it. We report on it, but I'll tell you as an analyst, it's a joke. Fiscal policy does work, but at a very high cost. And here it is. U.S. economy, it looks like it's growing about 2.4%, 2.5%, which, it's low compared to potential, but it's decent growth. But how much is the debt going up at the same time? The debt's going up faster. The debt's going up like 3.5% on an annualized basis. So are you running deficits? Yes. Are you getting some growth? Yes. But the debt is going up faster than the growth. And so this shows up in a measurement called debt to GDP. People throw around big numbers, and they are big numbers. $37 trillion of national debt. That's about right. But you can't really make sense of that number unless you put it in the context of the size of the economy. Simple example, if you owe $20,000 on your MasterCard, is that a lot or not? Well, if you make $20,000 a year, it's a lot. You're probably going bankrupt. If you make $500,000 a year, you can just write a check. And so you can't really learn much from the number, from the size of the debt. You have to compare it to the size of the economy. So what's that number? Well, that number is over 130% right now, which, by the way, is the highest in U.S. history. That goes back to late 1960s, so it's a good time frame. By the way, the number we have today is the highest in U.S. history. The last time it was even close was the end of World War II. It was about 120%. Today, it's about 132%. So it's the highest in history, highest at the end of World War II. But even in World War II, I like to say, well, we won the war. We spent a lot of money, we ran up a lot of debt, but we won the war with our allies. And the U.S. was a global hegemon. Our percentage of global production, global capacity, automobiles, whatever, it was off the charts. And we had a long run as the superpower. Today, we've got a higher debt to GDP ratio, but we haven't won any wars lately. We're losing on, Ukraine, losing in the Middle East. No one really respects the United States. We got leadership, et cetera. So we're not getting anything for our money. We're wasting the money. But it does have that effect I described. But the problem is at lower levels of debt. So let's say the debt to GDP ratio. Look at 1980, for example. It's about 30%. So that's when Ronald Reagan was sworn in. That was the lowest since World War II. I said it was 120% at the end of World War II. Yeah, but it was 30% in 1981. So how did you get from 120% to 30%? Because we had a lot of deficits. There were some surpluses, but mostly deficits during that time period. Well, the answer is we grew the economy. Yeah, the debt went up. It's not that the debt went down. The ratio went down. Even as the debt was going up, the economy was going up faster. It's seventh grade math. If you have a numerator and denominator, if the denominator is growing faster, the denominator is GDP. If the denominator is going faster than the debt, then the ratio is going down. What we have now is the opposite, where the numerator is growing faster than the denominator. The debt is growing faster than the economy, which means the ratio is going up. At a certain level, and by the way, the level is around 90% debt to GDP. We hit 90% in 2010. Welcome, Obama. So below 90%, here's what happens. You borrow $1, you spend $1, and you get more than $1 of growth. So you borrow $1, you spend $1, and you get $1.25 of growth. That's actually good, assuming you don't waste the money. That's a separate issue. But as long as the growth is greater than the debt, then your ratio is going down and your economy is solid. But as you get closer to 90%, that payoff, called the Keynesian multiplier, gets smaller. It starts to shrink. So you start out when you're down around where we were in the 80s, even the mid-90s. You borrow $1, you spend $1, you get maybe $1.25, but then it's like $1.20 and it's $1.10. And then as you get higher and higher, as you get closer and closer to 90%, it shrinks until you get to a point where you borrow $1, you spend $1, and you get 90 cents of growth. You don't get your dollar back. You don't get the dollar of growth. You get maybe 90 cents. Now, it's still growth. It's still growth. Somebody got paid, somebody got a job, et cetera. But your debt's going up faster. And as it goes up even higher, that multiplier, once it goes below 1, you're digging yourself into a hole, but it shrinks very rapidly. That multiplier was 0.68, not that long ago, meaning you borrow $1, you spend $1, you only got 68 cents of growth, not even close to $1. I've seen other studies that show it could be as low as 40%. Okay, so now the debt to GDP ratio is at an all-time high. We're not getting $1 worth of growth for $1 spent, but you're still getting growth. This is the part people don't understand. This is the part the politicians don't bother to explain. They point to the growth figure, say, look, we got some growth, and we did, but they ignore the debt figure, and that's going faster than the growth. So how does that end? It ends in one of several ways. For most countries, it ends in default. Argentina is a good example. You can set your watch by Argentinian defaults. They happen like every 10 years, like clockwork. But that's because Argentina, but a lot of other countries as well. We say, why can't they just print the money? Well, the problem is they print pesos, but they borrow in dollars. So if you owe dollars, you can't print the money because you don't have a dollar printing press. You have a peso printing press or any other currency that you want to name. You can't print the money to pay back the debt because you owe it in a different currency. You owe the debt in dollars, but you print pesos. So that doesn't do you any good. So what do? Well, you just default. Sorry, not paying you. Too bad, banks. Have a nice day. So that's usually what happens. The U.S. doesn't have that problem because we can print the money. So I don't expect a U.S. default because we owe $37 trillion. It's like, fine, print up $37 trillion, ship it over. But good luck buying a loaf of bread because what you do get in that situation is hyperinflation. There's no reason for the U.S. to default. There's no reason for the U.S. to restructure. We actually can print the money to pay off the debt. but that has consequences. And there are two. One is what I just described, which is really slow growth. The other one is hyperinflation. So right now, who's at our lunch table? Lebanon, Greece, Italy, Japan, the super debtors of the world. That's where we are. In the end, it's hyperinflation, but not right away. I'm not saying hyperinflation tomorrow or next month or next year. What you really get is slow growth. It's just a slow grind down. The rich get richer. The middle class gets demolished. Younger people can't afford, can't save. They're stuck in their parents' homes, can't get their own homes. Investment dries up, productivity declines, and you get this slow growth, occasional recession stage that lasts for a long time. And again, Japan is the example. Japan's the model of this. We are Japan. This is why I say we've been in a depression since 2007. We're in this slow growth phase. It's getting worse. But if somebody says, hey, Jim, we had 2.6% growth or whatever in the fourth quarter of 2024, where's the recession? And I'll say, well, it's coming. But the problem is you got that growth by borrowing more than you grew. But the reason Japan, the U.S. is the best model, the best way to understand the U.S., Japan is a country that borrows in a currency it prints. Japan's debt is in Japanese yen, and they print yen. The U.S. debt is in dollars, and we print dollars. So if your debt's in the currency you print, you're not going to default, but you are going to walk into hyperinflation. The old joke is there's 100 guys in the bar, and Bill Gates walks in. And on average, everyone's a billionaire. But there's actually only one billionaire in the room. His name is Bill Gates. Everyone else is just, having a beer. The point being, almost all the government statistics, not all of them, but almost all of them, are averages. But averages hide as much as they tell you. They tell you something, but they hide a lot. And what they hide is called the degree distribution, meaning what is any average? Well, it's a bunch of numbers, add them up, divide by the number of numbers, and that's the average. Okay. So when you see unemployment, or you see CPI, or you see real wage increases, et cetera, those are averages. Well, what's in the average? Let's just take CPI, for example. Well, in that CPI calculation, there are 100 or so subcomponents, big ones like gasoline, but, eggs, bread, butter, clothing, automobiles, furniture, and even broken down finally than that. And some of them are going up, some of them are going down. That's normal, but you have to look at that. But so when it comes to income, people say real wages went up by 1%, nominal wage increase minus inflation, real wages went up 1%. Sounds good. But what you discover is that some people, the real wages are soaring and everyone else is falling behind. So the average may be up 1%. But when you look at the degree distribution, you say, okay, what are the top 10% making? How's the bottom 10% doing? What about the middle 60%? How are they doing? You can even break it down, like you say, 10% brackets or whatever, and look at each bracket separately, and then break it out further, but what's happening in urban areas, rural areas, et cetera. But my point is, while the average may be kind of okay, the degree distribution is awful. All of that money is going to, a lot of it to stockholders, CEOs, government officials, tech entrepreneurs, et cetera. But that's a relatively small slice. Whereas everyday Americans, blue-collar workers, small business owners, healthcare workers, nurses, et cetera, they're just struggling. I mean, they might be getting a raise here and there, but it's not much. And then when you subtract inflation, it might be negative. So the only caution I would drop is that the numbers aren't great. They're like, okay. But the reality is worse, because when you go behind the average to look at how it's distributed between the rich and everybody else, you'll find that so much of that is going to the rich. Again, CEOs, stockholders, money managers, defense contractors, government officials, Nancy Pelosi, a small slice, and everyone else is being left behind. And that's why there's so much discontent.
What can someone in the middle class that's like, uh-oh, I'm about to get erased. There's tons of money being printed, and it's going to politician and Wall Street's best friends and not me. What can they do? What's like the number one investment they could do, or number one way of thinking about it? What could someone do right now?
This is going to sound obvious, but people actually, you say it, and people are all around, I know that, but they actually kind of don't. It's diversification. I'm not going to go through the economic theory of diversification. It actually works to get higher returns with less risk or the same risk. But people don't understand what diversification is. They say, oh, I'm diversified. I own 50 different stocks in 10 different sectors: semiconductors, minerals and mining, retail, consumer, discretionary spending, 50 stocks in 10 sectors. I'm fully diversified. And I say, no, you're not. You may have 50 stocks in 10 sectors, but you have one asset class. It's called equities or stocks, or whatever you want to call it. You have one asset class. You're not diversified at all. You're all in the stock market. And in normal times, when you don't need protection, they do behave idiosyncratically. But in stressful times, in a financial panic or monetary panic, they all correlate. They all go down together, and you lose a lot. You lose 40% of your net worth or whatever is in your investable assets. Real diversification, you can have stocks. There's a place for stocks, but have some cash, have some real estate, have some gold or silver, precious metals, have some alternatives. If you have a slice of each one of those, that's real diversification. Those asset classes do not correlate to a high degree in financial stress. So that's the answer. So let's just take stocks. I'm not saying get out of the stock market. I'm saying I would dial down my equity exposure. And then maybe if you're 80% in stocks, it might be smart to go to 40%. And then within the stocks you pick, what's going to perform well? It's pretty clear defense stocks are going to do well because the U.S. is behind the eight ball in a couple different wars, and we're going to have to bring up our game a lot. And they're going to have to spend more money on defense. The U.S. might as well just fold up its tent and go home. Healthcare, driven by demographics to a great extent. Natural resources, oil. Oil's been beaten down by this green new scam. I'm sorry, you're not getting away from oil and natural gas. If you're an insider, you're like Nancy Pelosi or her husband Paul, if you know that's coming because you're the one writing the legislation, you go out and buy the stock. That's one way to be worth, 25, 30 million on a government salary. And, the Congress are in on that. It's all wasted money. That's all very damaging to the economy. People can make an awful lot of money out of it. Oil and gas are not going away. They've been beaten down because of the green new scam propaganda. That's a very attractive sector. So oil, natural gas, defense stocks, healthcare are areas that will do well. But I would dial down my overall equity exposure. 40% seems a lot more comfortable than 80% given what's coming. This is going to sound really boring, but you know what? If you go to a good bank in your neighborhood and get a CD, they're paying 5%. People go back to the 10 years we talked about, 2009 to 2019, the banks were paying practically zero, maybe a quarter, 1%. You're like, we got to be an idiot to put your money in the bank because they're not paying anything. Go get some stocks or whatever. Well, there are reasons to have cash anyway for protection, diversification, liquidity in a crisis, etc. But the critics were right. They weren't paying you anything. Today they are. Now you have to get a CD. CD, you might lock your money up for a year. So it's not like a checking account. Don't put any money into a CD unless you can wait a year, 6 months or a year, whatever it is, because you're not going to be able to get it back without paying a penalty. But assuming you have the cash and you want the cash and you don't plan to spend it in the near term, go get a 1-year CD. They're paying close to 5%. Stocks are yielding about 3% in terms of dividends. So cash is outperforming dividends today. You put in $100,000, you come back a year later, you got $105,000. You didn't have to lift a finger. That's attractive. Gold, what can I say? It's up 30% in the last 3 months. I expect that to continue. We've done a lot on gold in the past for geopolitical reasons. It's obviously a good inflation hedge, but gold is more than that. We're calling in our publications the everything hedge. Does it protect you against inflation? Yes, it does. But it also protects you against war, geopolitical risk, financial meltdowns, and a lot else. And then some real estate, not commercial real estate. I think commercial real estate has not hit bottom, but farms, income producing real estate, just buy a bigger house, put an addition on your house. Don't over leverage it, but that's something you can sit on and that will pay off over the year. So the Treasury notes. First of all, 10-year Treasury notes are yielding close to 5%, not quite, I think about 4.6%. The 5-year note is a little closer to 5% because we have an inverted yield curve. So those are very safe instruments. You're going to get your money back from the U.S. Treasury. You have to worry about inflation, but that's where the gold comes in. See how diversification works. You're like, I bought a Treasury note, it's got a 5% yield, but what if interest rates go to 10%? Well, they might, but that's where the gold comes in. The gold's going to soar and it'll protect you. So that's how diversification works. If interest rates go down, which they will in a recession, you'll have big capital gains because bond math 101, interest rates down, bond prices up. If interest rates go down, you're going to have big capital gains on those notes. That will serve you very well. That will serve you very well. That will serve you very well. That will serve you